Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, listener, and thank you for joining us today. So we will be releasing our Q2 Global Market Outlook later today, titled More Conviction. As a result, we'll be running a 5-part mini-series of our Q2 Outlook podcast starting today, which will be released on a daily basis, so please look out for those. Today, I have with me Manpreet Gill to give us his thoughts on why, in a world of seemingly huge uncertainty, the CIO office has more conviction about our outlook. Specifically, we will talk about what history can teach us regarding whether the recent equity market rebound is likely to extend. What is the outlook for China's equity and bond markets? Are higher bond yields a risk or an opportunity for investors? And to what extent are higher oil prices a concern? So, Manpreet, let's get straight into it. So let's start with the title, More Conviction. So I get it that we've seen an 8% rebound in global equities over the past 2 weeks or so, after obviously a 13% decline before that. But what makes you more confident about the outlook? And is there anything that we can learn about history regarding the recent rebound in equities?
Hi, Steve. Actually, a lot of our confidence does come from looking back at history and placing the current sell-off and the subsequent pullback in perspective. Just to be more specific on that, I mean, we've actually compared the current pullback in the S&P as well as several other indices against past pullbacks, the start of prior Fed hiking cycles, and how markets have behaved around major geopolitical events. And I think it's interesting in each of those cases that the pullbacks were temporary, and in all cases end up being a great buy and dips opportunity. And so far, at least, the current pullback seems to be mirror those to a large degree. So if we compare the size of past pullbacks, for example, in the 2009 to 2020 bull market, the S&P pullback went anywhere from 10 to 19%. Peak to trough, and we saw about 12% on the S&P in the current cycle so far. It was similar around the start of prior Fed cycles. We've usually seen markets be a little bit volatile in the 3 months before and after the first hike of a rate hiking cycle, but usually that's not interrupted the long-term uptrend. And it's a similar story with geopolitical events where the market impact has usually been relatively short-lived. The big one, of course, is the worries about recession, because that's one change that could potentially pull markets into a much broader, long-lasting and deeper bear market. But when we look at our own checklist of recession indicators, there's been a debate about the yield curve, especially the 10-year, 2-year yield gap. But even that hasn't gone below zero, and by and large, none of our other indicators are flashing warning signs. So when you pull all of those measures together, the fact that markets have pulled back, and yes, they've rebounded to some degree, but that gives us much more confidence that is risk-reward favors adding risk at this time rather than reducing it.
Okay, so that's the sort of global backdrop. Let's come a little bit closer to home. And obviously, China markets have been extremely volatile over the course of the past. Actually, you can go back 12 months, right, for certain areas of the market. What's your view here? Is the tide turning?
Well, we think it very well could be. I think it's interesting, again, to start with a long-term perspective that when you think about a preference for Asia Japan equities, of which Chinese equities are a big part, actually not that much has changed over the past month. We had the sort of supportive turn in Chinese policy, and if anything, that intensified quite a bit over the past month. A lot of the pricing, market price suggests there's a lot of pessimism in the price. A lot of Asia is, of course, slowly taking baby steps, or more in some cases, to emerge from COVID restrictions. And several markets like North Asian equities, of course, have a significant correlation with the ongoing global recovery. Now, in China, we did have a couple of new setbacks over the past month. We had the unexpected rise in COVID cases and fears that China would get entangled in the Ukraine conflict. Now, because of that, we did trim a little bit of risk. So we reduced our preference for Chinese equities within Asia, Japan. But overall, we're still holding on to our bullish picture, given we still have Asia, Japan as our most preferred region. And the big one for us, of course, is the shift in policy, set against how much markets were sold back. After the excessive volatility we got quite some fairly strong statements from policymakers, pledging to support the economy. And when you look at how oversold markets were, just to add one perspective, the Hang Seng was at one point the most oversold on one measure since 1987. So quite a bit of bad news in the price. So that's on the equity side, at least. On the bond side, we're talking about high yield dollar bonds. The picture is relatively similar. I think what's common, of course, is that market prices are very beaten up, and there's already quite a bit of concern out there in terms of what the default cycle could look like. And once again, I think the policy turn is quite supportive, though what markets are likely to look for here specifically is measures to support liquidity, access to liquidity, whether that's from banks, from lenders, from the market, or any other sources, because that's really what holds the potential for turning the tide. So yes, there's some uncertainty still out there, but the prices are, we think, pricing in quite a bit of pain. So risk reward favors staying invested in our view.
Okay, let's develop the bond theme a little bit further, right? So if we look at I'm just looking at the 10-year US government bond yield since we published our 2022 outlook. So the bond yield's up around 1%. So it's around 1.4 when we published our 2022 outlook. It's around 2.4, just under now. So should investors be taking advantage of high yields for income today?
Well, we believe they should be selectively. And I think it comes down to being very specific about where investors are taking on their risks. At a broad income level, absolutely. If I think about multi-asset income, for example, yields are higher than where they were even at the start of the year. But at one level, we still think it makes sense to avoid taking excessive risk with rate-sensitive assets, because while the 10-year yield is now well within the range we expected in the latter part of the year, the risks in our view are still to the upside. So we still have a preference for high yield bonds. In most regions, we have a preference for subordinated financials, floating rate bonds, and we just talked about Chinese and Asian dollar bonds. And the commonality with all these factors is that yes, yields are higher, but they tend to be more sensitive to changes in credit risk rather than US government bond risk. So we still think that's still a focus. Now, in terms of bonds that are sensitive to changes in US government bond yields, we do think there are selective opportunities. And the one specifically we think offers an opportunity today is EM dollar government bonds. Now, this is, of course, quite sensitive to changes in US government bond yields, but credit spreads have also blown out quite a bit because emerging Europe is one component or one sector within this asset class. So that combination, to our view, does represent an opportunity because yields have risen by a lot. But also we've got the combination of spreads having widened quite a bit. So together, we think that's an opportunity where we'd upgrade our view on the asset class.
Okay, and I think from a different perspective, obviously you focus very much the income generating capability of bonds, but we shouldn't forget that we believe that for a multi-asset income portfolio, high dividend equities are a very important component as well, both in terms of short-term income, but also in terms of long-term capital appreciation. So just note that. So maybe just risks, right? So, I mean, it's on the newspaper's front page almost every day. Oil prices going up, making new highs, at least recent highs. Is that something that you're worried about?
It's something we'd watch quite closely. I don't think I would say we're very worried about it just yet, but we do think the risk is that oil prices stay elevated or potentially even rise a little bit further. And there are two specific risks that support that case. First is that we haven't quite seen the response from OPEC or shale oil producers in terms of increasing output in response to where prices are. That's definitely been slower than we would have expected. And, just following the geopolitical sort of conflict in Ukraine and the sanctions accompanying it, there is a not insignificant risk that more and more Russian oil becomes inaccessible to buyers around the world. So those are two factors that do argue, for higher oil prices. So the question is how much. I think that's always the important factor and what we watch closely as a risk. The good news, though, is that while a lot of comparisons are made to 1970, the world economy's energy intensity, or the amount of oil required per unit of GDP, is a lot lower. One report, of course, said it's almost halved or more since the 1970s. So clearly, there's more ability to weather an energy price shock, and of course, the move to renewables, if anything, intensifies that. Our takeaway is that, look, it doesn't take away from a broader conclusion that we'd rather be adding to risk today rather than taking away, but there are two ways to hedge against the risk of further rise in oil prices. One, of course, a preference for energy sector equities. We think they have, of course, benefit from higher oil prices, but they have room just to catch up, even if oil prices stay where they are. And second, of course, select commodity currencies, and the Canadian dollar being a great example of one that is correlated with oil prices.
Yeah, and I guess if you want to look at the glass half full, higher oil and energy prices, will encourage people to embrace climate change and greener energy forms of electricity. So from that perspective, I think this could be seen as a good thing in the big picture. Okay, so that's all we have time for today. Thanks, Manpreet, as always, for jumping into the hot seat. And thank you, listener, for joining us as well. On Monday, Manpreet will be back with his cut to the chase wrap up of weekend developments and what it means. Meanwhile, I'll be talking to Rajat Bhattacharya about how the world is shaping up from an economic perspective. Hope you're able to join us. In the meantime, thanks again for joining and wishing you a wonderful weekend ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.